Please like, share, and subscribe. Wishing you happiness and good luck every day.
Welcome to The Explainer. Today, we're going to deconstruct 6 key elements of intelligent investing, and we're pulling them straight from Shamgad's fantastic book, The Business of Value Investing. This is a really powerful mental framework that's designed to help you think about investing not as some kind of gamble, but as a real business operation. So let's start with this quote from Benjamin Graham, who is, the father of value investing. This one idea is pretty much the cornerstone for everything we're about to discuss. It's a total game changer. So forget the charts, forget the tickers, forget the hot tips. The goal here is to treat every single investment with the same seriousness as if you were buying an entire company, lock, stock, and barrel. All right, here's our game plan. First, we're going to tackle a fundamental shift in mindset. Then we'll dive into this 6-element framework, piece by piece. By the time we're done here, you'll have a complete roadmap for making truly intelligent investment decisions. Okay, so here's the deal. Most people, when they think about investing, they treat it like a casino. They're just focused on the flashing lights, the ticker symbol, and the stock's price going up and down. But a stock, that's just a piece of paper. The real lasting value is in the actual business behind it, the people, the products, the cash flow. And that's the problem we need to solve first. And this slide really highlights that critical difference. On one hand, you have the speculator. They're basically a slave to their emotions, getting pushed around by market noise and just following what everyone else is doing. But on the other hand, you have the business owner. They're a master of logic, laser-focused on the company's fundamentals, and they think for themselves. Our goal is to move you from that first column over to the second. This quote from Warren Buffett just captures it perfectly. It's this symbiotic relationship, right? When you understand business, how a company actually makes money, what its advantages are, it makes you a way better investor. And on the flip side, when you analyze investments, digging into the financials, assessing value, it makes you a better business person. It's this incredible feedback loop that gives you a massive edge. So, how do we actually make this jump from speculator to business owner? Well, the answer lies in what you could call a mental latticework, made up of 6 interconnected elements. Think of it like a decision-making system, almost a mental checklist that will guide you towards smarter, more rational choices. These 6 blocks are the foundation of the whole thing, and it's really important to see them as a sequence. You can't have a good search strategy without a solid philosophy, and you definitely can't have real conviction if you haven't done a thorough evaluation. Each element builds on the one before it, creating this chain of logic that's really tough to break. So, you ready to jump in? Let's get started with the first 2 elements. This is the bedrock of our entire framework. This is where all the magic starts, way before you even look at a single company. So, the first element is your philosophy, and it really boils down to one thing: protecting your capital. This isn't about being timid, it's about being smart. We're not going to worry about the day-to-day price swings. That's just volatility, it's just noise. What we're really focused on is avoiding a permanent loss of your hard-earned money. And the price you pay for an asset, that is your #1 weapon in this fight. Okay, once you have that solid defensive philosophy locked in, you're ready to start your search. But we are not going to be swayed by what the media is hyping up or the latest financial news. Honestly, that stuff is just a distraction. We're going to use a systematic filter to find those hidden gems, those undervalued businesses with huge potential that pretty much everyone else is overlooking. They say imitation is the sincerest form of flattery. Well, in the world of investing, it's also a brilliant strategy. Why not stand on the shoulders of giants? Why not see what some of the most successful investors out there are buying? By looking through their public SEC filings, you get a curated list of really interesting ideas to kickstart your own deep dive. It's an incredible head start. All right, now we're getting to the real heart of it, the analytical core. You found a company that looks promising, but now comes the hard part. You've got to figure out what that business is actually worth, and then you have to have the guts to act on your analysis, especially when it feels uncomfortable. The goal here is pretty simple, actually. Find the gap. The gap between what a business is truly worth, its intrinsic value, and what the market is willing to sell it for today. We're basically on a treasure hunt for bargains. We're looking to buy $1's worth of a great business for, 50 cents. This is the holy grail of valuation, the margin of safety. Warren Buffett calls these the 3 most important words in investing, and it's your secret weapon against the unknown. It's your safety net. So if you believe a business is worth $100 and you can scoop it up for $60, well, you've just built in a $40 cushion to protect you from surprises or, let's face it, your own mistakes. So how do we bring this concept to life? Well, this slide gives us a clue. Intrinsic value isn't just some number you pull out of thin air. It's rooted in a company's ability to generate cold, hard cash. By looking at a business's operating cash flow over time, we can get a much clearer picture of its true economic worth. At the end of the day, it's all about the money it's making. This is where the rubber really meets the road. I mean, you can do all the analysis in the world, but it won't help you one bit if you don't have the discipline to just say no. It's about having the strength to walk away from a fantastic business if the price isn't right. And it's about ignoring that siren song of popular trends that's luring everyone else in. And this quote just captures that psychological battle perfectly. It takes real guts to stick to your analysis when everyone, and I mean everyone, is jumping on the bandwagon. You have to be willing to look like you don't know what you're doing in the short run because you know your discipline is what's going to save you from making a huge mistake down the line. We are now entering the master class. If you think of valuation and discipline as the foundation, then patience and conviction are the finishing touches. This is what really separates the good investors from the truly great ones. So the fifth element is the art of patience. It's about fundamentally understanding that the stock market is a marathon, not a sprint. You have to be willing to wait for that perfect opportunity, that perfect pitch, as Buffett would say, and you have to be comfortable just letting your cash pile up when there's nothing good to buy. You have to become a master of doing nothing while everyone else is frantically trading. And this is the ultimate test of your character. After all your hard work, your philosophy, your search, your valuation, your discipline, your patience, you have to have the courage to act decisively, to go big when everyone else is running for the hills. It's about buying when there's blood in the streets, when fear is at its peak, because that's when you find the absolute best bargains. Here's a really key insight from the book. You can only act with that kind of conviction if you've completely internalized the other 5 elements. It is an all-or-nothing proposition. You can't cherry pick. It's a complete, integrated system that has to work together to give you the strength to succeed when others are just paralyzed by fear. Now, this table is such a powerful reminder that popularity is often a terrible indicator of future returns. As the book points out, if you had just blindly invested in whatever the most valuable company was each year, you would have actually underperformed the market. The best opportunities are almost always found where nobody else is even looking. So, there you have it, the complete mental lattice work for making smart, business-like investment decisions. This 6-element framework is your guide to a more consistent, more rational, and frankly, a more risk-managed way to build wealth over the long term. This whole framework, it transforms you from a reactive speculator into a proactive business person. But the analysis, that's just the start. As we've seen, the real test is your temperament. The framework is yours now. So the only real question left is, are you ready to use it? All right, let's talk about one of the biggest, most important ideas in all of investing. You know, it's one of those things that people say all the time, but do they really get it? It's all about a simple, powerful shift in how you see things. It's about learning to invest in the business, not just the stock. And, you know, this idea isn't new. This guy right here, Benjamin Graham, the father of value investing, he laid out the whole blueprint decades ago with this single sentence. Investment is most prudent when it is most businesslike. It sounds so simple, doesn't it? But what in the world does being businesslike actually mean when you're clicking buy on a screen? Because let's be honest, for a lot of us, there's a very fine line between analyzing a real company and just getting completely mesmerized by that little green and red line going up and down all day. So let's make this crystal clear. And the best way to do that? With a story. And look, this isn't some textbook theory. This is a lesson that was learned the hard way. It's a classic case of doing all the right research, but having the completely wrong mindset when things got a little shaky. So picture this. The year is 2002, and the company is Meridian Medical. I mean, on paper, this thing was a dream. It made life-saving auto-injectors, had zero debt, was trading at a fair price, and get this, it had a virtual monopoly because of its FDA approvals. It was a textbook value investment if there ever was one. So the purchase was made, right around $33 a share. But then the company came out with a slightly meh earnings report. The business was fine, but the market freaked out. And the stock, it just plummeted down to 22. And this is where the critical mistake happened. Instead of trusting the analysis of the business, panic took over. and every single share was sold. The regret? Oh, it was a big one. Less than a year later, the stock was back over $40 and then got bought out for an even bigger premium. A massive, massive gain was just gone. You know, a painful experience like that really drills two lessons into your head that you never forget. First, your buy and sell decisions have to be anchored to what the business is actually worth, not what the crazy emotional stock market says it's worth on any given day. And second, you absolutely have to think for yourself. The analysis wasn't wrong. The mistake was letting the market's panic convince you that it was. And this whole story really brings us to the absolute core idea we have to nail down as investors. You have to realize there are two totally different games being played, and you've got to know which one you're playing. This slide just lays it out perfectly. On the left side, you've got the stock. That's the world of constant noise, emotional gut reactions, daily price quotes, and Benjamin Graham's famous Mr. Market with his wild mood swings. But on the right side, you've got the business. This is the world of real value, of cold, hard analysis, of cash flow and long-term performance. Your job, your entire goal, is to live on the right side of this slide. I mean, wow, that's a pretty intense quote, right? Especially when you hear it comes from a Wall Street veteran. Now, he wasn't saying markets are useless, but he was making a brilliant point. We can't confuse the frantic, high-frequency trading on an exchange with the actual, slow and steady work of a business creating value over time. They're two different things. So here's the bottom line. For an investor who thinks like a business owner, the stock market only has two purposes. That's it. It's there to serve you a business on a silver platter at a bargain price when everyone else is running for the hills. And it's there to let you sell that business at a fair or even inflated price when everyone else is euphoric. Any other time, it is just noise, pure noise. And your job is to ignore it. So to make this feel a little more real, let's just forget about ticker symbols and stock charts for a minute. Let's start thinking like we're actually buying a real physical business right down the street. Let's think like a shop owner. Okay, so here's our scenario. There's a local bike shop for sale. The owner's asking $100,000. Now, you're not going to make this decision based on some gut feeling, right? Or what your neighbor heard about the bike industry this week. No way. You're going to do the work. You are going to be businesslike. So where do we even begin? Not with revenue, not even with profit. We start with the thing that matters most, free cash flow. Just think of it like this. It's the actual, cold, hard cash that's left in the owner's pocket at the end of the year after every single bill is paid. And as you can see from the shop's history here, that cash flow has been growing nice and steady. That is a very, very good sign. Okay, but remember, we're not buying the shop's past, we're buying its future. So the next step is to make a reasonable guess about what that cash flow is going to look like for the next, say, 5 years. Now, here comes a really important concept. We have to discount those future earnings. Why do we do that? Well, because a dollar that you're promised 5 years from now is worth less than a dollar you have in your hand today. It's just common sense. So when we apply a discount rate, we find out what all those future cash flows are worth to us right now. And in this case, it's about $67,000. But wait, the bike shop isn't just going to close its doors in 5 years, right? We hope it keeps making money for a long, long time. So we have to estimate what the business is worth beyond our specific forecast. And that's a little something called terminal value. A simple way to think about it is to assume we could sell the business down the road for, say, 5 to 7 times its cash flow. That gives us a future value of somewhere between $60,000 and $85,000. Okay, now for the fun part. We just add it all up. We take the value of the next 5 years of cash, that was the $67,000, and we add on the terminal value. And what do we get? Our analysis shows this bike shop is actually worth somewhere between $127,000 and $150,000. And suddenly, that $100,000 asking price doesn't just look fair, it looks like a bargain. We've made a real business-like decision. And you know what? This isn't just some cute little analogy for a bike shop. This is exactly how the greatest investors on the planet operate. So let's take a look at a real masterclass in action. Let's rewind to the early 1970s. Warren Buffett is looking at the Washington Post company. Now, this wasn't just a newspaper. It was a collection of amazing media assets. The Post itself, Newsweek magazine, several huge TV stations. Buffett wasn't staring at a stock chart. He was looking at the collection of businesses. At that moment in time, the stock market, in all its collective wisdom, had decided that all of those incredible premier assets, all together, were worth only $80 million. That was the stock price. That was Mr. Market's opinion. But Buffett, He did his homework. He looked at it like a business owner. He added up the pieces and figured that if you were to sell off each of those assets individually, they'd easily bring in at least $400 million, maybe even more. He was seeing a business that was worth 5 times what the market was telling him. So he didn't buy the stock. He bought the business. So what was the end result of ignoring the market and trusting his own analysis? Well, his initial investment of about $11 million grew to be worth over $1.3 billion by 2007. That right there is the absolutely staggering power of focusing on business value and treating the stock market's daily chatter as nothing more than noise. So how do we actually do this? How do we put all of this together into a mindset that lets us use the market to our advantage without letting it use and abuse us? Let's try a little thought experiment. This is a powerful one. Just imagine that the stock market was only open for business one single day per year. January 1st, you can buy or sell, and then it's closed until next year. No daily quotes, no checking your phone every 5 minutes. How would that dramatically change your behavior? Well, the answer is pretty obvious, isn't it? All of that short-term speculation would just evaporate. You wouldn't be gambling on what a stock might do in the next 3 months. No, you would spend all your time trying to deeply, truly understand the business itself, its products, its managers, its long-term future. Why? Because you'd have to be sure. You'd have to live with that decision for a whole year. You would be forced to invest like a business owner. I absolutely love this quote from Buffett because it just cuts through all the complexity. Investing isn't about finding some flashy, exotic, high-priced story stock like buying perfume. It's about methodically going through the aisles, looking for high-quality items that are selling for a sensible price. It's just like buying groceries. It's practical, it's disciplined, it's not emotional. So really, that's the final question. It's the one you have to ask yourself every single time you think about making an investment. When you see that stock price bouncing around, are you reacting to the noise? Are you reacting to the stock? Or are you holding firm to your deep understanding of the business? Because truly, the answer to that question is what will define your success as an investor. All right, let's talk about investing. If you've ever felt like the stock market is just one big, chaotic casino, then you're in the right place. Today, we're going to cut through all that noise and get down to a more disciplined, kind of business-like way of thinking about it. We're going to break down a philosophy that's been the secret sauce for some of the world's greatest long-term investors. I love this quote from A.A. Milne because it just perfectly sets the stage for us. See, great investing isn't about blindly following the crowd. And it's not even about just doing the opposite of the crowd. It's about the simple, powerful act of thinking for yourself. Clearly, rationally, and without getting swept up in all the emotion. And that's the mindset we're going to dig into. So why is that kind of an independent thinking so important? Well, have a look at this number, 85%. That's the percentage of professional, active money managers who, over the long haul, fail to beat the market. 85%. We're talking about the pros, the people paid big bucks to do this, and most of them can't even beat the average. That should tell you something, right? Whatever the majority is doing probably isn't the winning strategy. And part of the reason for that crazy failure rate is that, in the short run, the market really is a zero-sum game. Every time you buy a stock, someone else is selling it to you. You think it's going up, they think it's going down. One of you is going to be right. Just think back to the dot-com bubble. For a while, it seemed like everybody was a genius, right? But when that party ended, wow. For every person who got rich on the way up, a whole lot more lost their shirts on the way down. So how do we make sure we're on the winning side of that trade more often than not? Well, that's our game plan for today. We're going to look at a philosophy that gives us a logical way out. We'll talk about why not losing money is the real rule number 1. Then we'll learn a super simple way to categorize any investment, put it to the test with a real company, and wrap it all up with the one secret ingredient that ties everything together. The solution really comes from this one man who's often called the intellectual patriarch of this whole idea, Benjamin Graham. You know, before Graham came along, the stock market was pretty much the Wild West. He was the one who came along and said, hey, maybe we should approach this with some logic, like we're buying a business, not just a lottery ticket. And this right here is his timeless definition of what an investment actually is. It's an operation that after you've done your homework promises 2 things, safety of your money and a decent return. But then he adds the kicker, and this is the most important part. Anything else is just speculation. He draws this bright, clear line in the sand. If you're not meeting all 3 of those criteria, you're not investing, you're gambling. These 3 steps are the absolute pillars of this way of thinking, and you have to get the order right. It is critical. First, you do the work. Thorough analysis. You got to know what you're buying. Second, and this is before you even dream about the profits, you make sure your initial capital is safe. Can you get your money back? And only after you've checked those 2 boxes do you even start to think about number 3, a satisfactory return. Let's really hammer down on that second point, because it's the one that everyone seems to forget. Preserving your capital comes first. Your main job as an investor isn't to get rich quick, it's to not get poor. If you can just avoid the big mistakes, the big losses, the gains have a funny way of taking care of themselves over time. This is the mantra that just perfectly captures that whole mindset. It's about finding opportunities where the upside is huge, but the downside is small and manageable. You're trying to rig the game in your favor. Let me show you how powerful this is with some really simple math. Okay, so let's imagine we have 2 investors here, Investor A and Investor B. They both start with $100. In year 1, the market stinks. Investor A, our careful one, loses 10%. Investor B, who was a little more aggressive, gets slammed and loses 25%. But then, for the next 3 years, the market comes roaring back. Now here's where it gets wild. In the good years, Investor B actually gets better returns. So you'd think they'd catch up, right? But look who ends up with more money. It's Investor A. Just by avoiding that one big loss in the first year, Investor A ends up with over $124, while B is stuck at $114. That single painful loss absolutely crippled B's long-term results. That is the simple, brutal math of protecting your capital. Okay, so if the big goal is to avoid those huge losses and find those heads I win, tails I lose a little kinds of bets, how do we actually do it? Well, value investors use a surprisingly simple framework. They don't see a market with thousands of confusing stocks. They really only see 3 kinds of companies. That's it. That's the whole game. Every single company out there, from the hottest new thing to the most boring manufacturer, falls into one of these 3 buckets. Its stock price is either too low, too high, or about right compared to what the business is actually worth. The entire job of a value investor is to sift through the noise and find the businesses sitting in that first bucket, undervalued. So how do we start to figure this out? Well, a really common tool is the price-to-earnings ratio, or PE. It's just a simple way of asking, how many dollars do I have to pay to get $1 of this company's profits? So if a stock has a PE of 10, you're paying 10 times its yearly profit. And logically, a lower number seems like a better deal. Another great one is the price-to-book ratio, or P/B. The best way to think about book value is like your own personal net worth. You take everything you own, your assets, and you subtract everything you owe, your liabilities. What's left over is your net worth. The P/B ratio just compares the company's stock price to that net worth. Generally, paying a price closer to what the company's assets are actually worth is a more conservative way to invest. So if we're hunting for these cheap stacks with low PE and PB ratios, where do we look? Warren Buffett absolutely nails it with this quote. Value investors aren't pessimistic people, but they love the prices that pessimism creates. When the market is freaking out about a company or ignoring an entire industry, that's when the rational buyer can step in and find a bargain. They thrive on fear. Okay, enough theory, let's make this real. Let's walk through a quick and dirty valuation of an actual company, Mohawk Industries. They make carpet and flooring. This will show you how we can go from just talking about these ideas to actually applying them. So if you just take a quick glance at Mohawk's numbers from 2004 to 2006, things look pretty good, right? Sales are growing, profits are climbing. On the surface, it looks like a solid, healthy business. Nothing to see here. But as an investor, we need to dig deeper than just reported profits. We want to see the cold, hard cash. A company can show a profit on paper, but have no cash coming in the door. Operating cash flow shows us what's really happening. And for Mohawk, whoa, the picture gets even better. Look at that cash flow just exploding upward. That is a very good sign. Now we take it one last step to the holy grail, free cash flow. This is the cash that's left over after the company pays for all the new factories and equipment it needs to stay in business. This is the real pot of gold at the end of the rainbow. This is the money that could theoretically be handed right back to the owners, the shareholders. And for Mohawk, this number looks fantastic. So that leads us to the million-dollar question, or in this case, the multi-billion-dollar question. We've established it's a good business, throwing off tons of cash. But what is it actually worth? Because remember, a great business can be a terrible investment if you pay too much for it. Here's a very simplified way of figuring that out. We try to project those future cash flows, and then we have to discount them back to today. It's a fancy way of saying that a dollar in your pocket today is worth more than a promise of a dollar 5 years from now. So we run the numbers, add up the value of all those future years, and it gives us a conservative estimate for what the whole business is worth today. And this, right here, is where the magic happens. After we run the numbers, our conservative estimate says the business is worth somewhere between 83 and 97 bucks a share. But back in June of 2009, when everyone hated the housing market, you could buy the stock for around $35. Do you see that gap? That massive difference between price and value is exactly what a value investor lives for. That huge gap between the $35 price and our $80+ estimate of value, that's not just our potential profit, it's something much, much more important. It is the final and most critical concept that holds this entire philosophy together. Benjamin Graham himself said that if you forced him to distill the secret of sound investment down to just 3 words, these would be it: margin of safety. This isn't just a part of the philosophy, it's the absolute cornerstone. So what is it? The margin of safety is simply that gap we found. It's the difference between the low price you pay and the high value you think you're getting. Why does that matter so much? Because you're going to be wrong sometimes. Your estimates won't be perfect. The world might change. The margin of safety is your cushion. It's your room for error. It's what protects you if you mess up or just get unlucky. It's what makes the bet, tails, I lose little. Okay, so let's just quickly bring it all home. What are the big ideas to remember? First, prices in the short term are kind of crazy and emotional, so we ignore them. We look at stocks not as ticker symbols, but as little pieces of a business. Our entire goal is to find good businesses that are undervalued. And we do that by focusing on what really matters, like how much cash they produce. And finally, the most important rule of all, always, always demand a margin of safety. And that brings us to the final question, the one I want to leave you with, because this one little shift in how you think can change everything. So the next time you're about to put your hard-earned money to work, just stop and ask yourself, am I buying a stock ticker that wiggles around on a screen, or am I buying a small piece of a real, living, breathing business? The answer to that question makes all the difference in the world. All right, today we are breaking down the mental framework behind one of the most successful investment philosophies in history. We're going to explore a structured way of thinking that promises something that sounds, well, almost impossible: getting higher returns while taking on lower risk. Let's dig in and see how that actually works. So let's just start with an idea that kind of turns everything you've probably heard about finance on its head, right? The conventional wisdom is you want bigger returns, you got to take bigger risks. But this quote, which is really the soul of value investing, says the exact opposite. It says the biggest rewards don't come from the biggest gambles. No, they come from finding amazing assets when nobody else wants them. You know, to really get this, let's just forget about the stock market for a minute. Picture this: a gorgeous beachfront house in Hawaii, the kind of place you see on postcards. In a normal market, this thing is an easy $2 million, no question. But then a couple of nasty storms roll through the area. The news goes crazy, buyers get spooked, and the market just panics. Now, the house itself is perfectly fine, structurally sound, but the price has absolutely collapsed to just $400,000. That is an 80% discount on paradise. I mean, it's a no-brainer, right? You'd scrape together every penny you could and buy as many as possible. And think about it. You're not just betting it goes back to $2 million. Even if it only recovers to half that, to $1 million, your return is still gigantic. This simple, rational act, buying something for way, way less than its actual worth, that's the core idea of intelligent investing. Doesn't matter if it's a house on a beach or a piece of a giant company. But here's the thing. Thinking this rationally about stocks, well, that wasn't always how things were done. For the longest time, the market was seen as more of a casino for gamblers, not a laboratory for analysts. Until one man showed up and basically rewrote all the rules. In the early days, investing was a total free-for-all. People bought stocks on rumors, on hunches, on a wild dream of hitting the jackpot. It was chaotic. But then came the Graham Revolution, and it completely transformed this wild gamble into a methodical, almost scientific process based on cold, hard facts. So this one guy, Benjamin Graham, a professor at Columbia University, he didn't just have a good idea. He literally wrote the book on this stuff, twice. First, in 1934, he gave us security analysis, which is still basically the Bible for figuring out what a business is actually worth. Then, in 1949, he published The Intelligent Investor, which took all those powerful ideas and made them accessible to everyday people like you and me. And right at the absolute heart of his entire philosophy is this one super critical distinction. He basically drew a line in the sand. He argued that anything you do with your money is either an investment or it's speculation. There is no gray area. If what you're doing doesn't meet his strict criteria for an investment, it's a gamble, period. So what does it take to cross that line? What makes something a real investment in Graham's eyes? Well, it has to pass his three-point test. No exceptions. First, you have to do a thorough analysis. You have to understand the business like you were going to buy the whole thing. Second, your number one priority has to be the safety of your principal. You do that by always buying with a margin of safety. And third, it has to promise an adequate return. Not necessarily a home run, but a good, solid return for the work you put in. Now, Graham's ideas weren't just some dusty old theories from a professor. No way. They went on to create a whole generation of investors who use this exact framework to post just legendary returns, managing trillions of dollars in the process. And his most famous student? Well, you've probably heard of him, Warren Buffett. From the time he took over this little failing textile mill called Berkshire Hathaway, he used Graham's principles to achieve this. Just look at this number, 21.1%. That's not for 1 year. That's the compounded annual gain, year in and year out for over 4 decades. It's just staggering. And Buffett's not some one-off genius. He's just the most famous example. This slide is like a who's who of investing titans. You've got guys like Peter Lynch, who ran the Magellan Fund so well it became the best-performing mutual fund on the planet, and Seth Klarman, whose book on value investing is so rare and sought after it's a collector's item. Every single one of them built their success on the foundations that Benjamin Graham laid. So what's one of the biggest lessons we can learn from all these masters? It's that you have to be comfortable being, well, a little lonely. The truly great opportunities are almost never found where everyone else is looking. Like Buffett says here, if everybody agrees it's a great idea, if the consensus is cheery, you're probably about to pay way too much. And this slide, this is that principle in action. Just look at this Barron's cover from 1999, right at the absolute peak of the dot-com insanity. Everybody was getting rich on tech stocks, and Buffett was getting publicly mocked for not buying them. Why? Because he said he didn't understand them. The media said he'd lost his magic touch. Well, a few years later, that bubble burst. Trillions of dollars vanished, and his discipline looked pretty smart, didn't it? So this kind of discipline, it doesn't just come from willpower. It's not about being stubborn. It's one piece of a complete interlocking mental framework that guides every single decision these great investors make. So now let's dive into the 6 elements that make up this powerful model. Okay, let's walk through these 6 elements because the magic isn't in any single one of them. It's how they all work together. It has to start with a deep commitment to a solid philosophy, like the one we're talking about. That's your anchor. That philosophy then drives how you find companies. You're not chasing tips anymore. You're searching methodically. Then you need the skill to value that business accurately. But that's just the numbers part. Next comes the hard part, the emotional discipline to say no, even to a great company if the price isn't right. And that takes incredible patience, the willingness to wait, sometimes for years, for your price. And then finally, when that perfect opportunity comes along, usually when everyone else is panicking, you have to have the courage to act decisively and buy. You know, that 4th element, discipline, that might be the toughest one of all. We can call it the Chipotle test. You might absolutely love their food. You see the lines out the door. You just know it's an amazing business. But that passion can be a trap. A great business is not a great investment if you pay too much for it. Discipline is being able to separate your feelings about the company from the cold, hard math of its stock price. So, and this is really, really important, these 6 elements are not some simple to-do list that you can just check off one by one. They're all connected. They feed into each other to build a powerful way of thinking about investing. One element is basically useless without the others. Buffett's legendary partner, Charlie Munger, he has the perfect name for this, a mental latticework. Think of it like the rebar inside a concrete structure. Your ability to be patient, for example, is directly supported by your confidence in your valuation. Your discipline to say no is reinforced by your deep commitment to your philosophy. They all hold each other up. And when you build that latticework, it causes this incredible shift in your mindset. It's what separates the amateurs from the pros. Amateurs are obsessed with the outcome. Did my stock go up today? Professionals are obsessed with the process. Did I stick to my framework? Was my analysis solid? They know that if the process is right, the good outcomes will take care of themselves over time. In the end, this entire philosophy, this whole way of thinking, it can be boiled down to this one powerful idea from the man who started it all. Your success as an investor doesn't come from being popular. It doesn't matter what the crowd thinks. It comes from the quality of your own work and the soundness of your own logic. And that's really the question this whole framework empowers you to answer for yourself, isn't it? If you've done the homework, if you've followed the process, if your data and reasoning are solid, then why on earth would you let the chaotic emotions of the crowd dictate what you do? Answering that question is what it means to be a truly intelligent investor.
Welcome in. Today, we're not just going to talk about tips and tricks. We are going to build, from the ground up, a complete investment philosophy. A real framework that's designed to help you think like the world's absolute best investors.
All right, so here's our game plan. First, we're going to really define what it means to be an investor, not a gambler. Then we'll get into the one rule that trumps every other rule. From there, we'll see how the price you pay can literally make or break your entire success. We're going to redefine what risk actually is, and then we'll expose the common traps that sink most people. And then finally, we'll wrap it all up with the powerful absolute return mindset.
So let's start at the beginning, with the foundation. You got to forget what you think you know about value investing. It is not about buying cheap, broken companies. No, it's a complete, all-encompassing philosophy for how you should approach the markets.
This quote from the legendary investor Seth Klarman, it hits the nail on the head. Let's really break this down. In-depth analysis, that just means doing your homework. Long-term results means you're planting a tree, right? Not buying a lottery ticket. Limiting risk, well, that's your defense. And resisting crowds, honestly, that might be the hardest part. It's having the courage to stand all by yourself when everyone else is running for the exit.
Okay, this right here, this is probably the single most important distinction you'll ever make. Investing means you are buying a piece of a real, living, breathing business based on what it's actually worth, its profits, its brand, its future. Speculating, that's just gambling. You're just betting on a squiggly line on a screen hoping it goes up, and you're doing it with pretty much no more reason than a gut feeling or something you read online.
And here is this exact philosophy out in the wild. Let's go back to 1973. The market was in a total panic, and it valued the entire Washington Post company at just $80 million. But Warren Buffett, he just ignored the noise. He did the work, he did the analysis, and he realized that just a few of their assets, their TV stations, their buildings, were worth over $400 million by themselves. So the market was literally offering him a dollar bill for 20 cents. He took the deal. That is investing.
And now, let's talk about the single most important rule in this entire philosophy. Seriously, this isn't a suggestion. It is the non-negotiable bedrock of everything else we're about to cover. Warren Buffett famously boiled this all down to two simple rules. Rule 1, don't lose money. Rule 2, don't forget Rule 1. Now, it sounds almost comically simple, right? But it's actually incredibly profound. Before you even dream about the upside, you have to become obsessed with protecting your downside. Your offense starts with your defense.
I love how investor Monish Pabrai put it, heads I win big, tails I don't lose much. Think about that. It's like a rigged coin flip. You're only willing to play the games where the potential winnings are massive and the potential losses are tiny. You are actively looking for opportunities where the odds are just overwhelmingly stacked in your favor.
And this gets us to a really critical distinction. A falling stock price is not the same thing as losing money. Let me say that again. If you own a great business and its stock price drops, that's just a paper loss. The only way it becomes a permanent loss is if you panic and you sell. The true investor holds on, knowing the business itself is fine, while the speculator sells right at the bottom, turning a temporary dip into a real, painful, permanent loss.
Now, let's look at how the price you pay for an investment is what ultimately dictates your future results. I mean, you can buy the best company in the entire world, but if you overpay for it, your returns are going to suffer. It's as simple as that.
History gives us a brutal lesson on this. Just imagine you invested in the broad market back in 1965, and you hold on through recessions and booms and busts for 17 years, a whole generation. And in 1981, you look at your account, and your return is zero, nothing, zilch. But an investor who just waited one more year and bought in 1982, when prices were lower, they experienced one of the greatest bull markets in history. Same market, different starting price. Your entry point is everything.
And hey, this isn't just a one-off story. The data absolutely proves it. Okay, let's take a second with this table. It's not as complicated as it looks. It basically organizes market history into 10 groups based on how expensive the market was at the start. Now just focus your eyes on that bottom row, decile 10. This is when the market was the absolute cheapest, when PE ratios were low. Now look all the way across to the right, the average return, a fantastic 13.4%. Okay, now look at the top row, decile 1. This is when the market was most expensive, when everyone was euphoric. That return, it plummets to just 3.2%. The proof is right there in black and white. Buy cheap, do well. Overpay, and you are fighting a losing battle from day one.
And if that table wasn't clear enough for you, well, this chart makes it impossible to ignore. Let's just break it down real quick. On the left side, you've got the starting price, how expensive the market was. High up is expensive, low down is cheap. And along the bottom is your future 20-year return. I mean, just look at the pattern. Every single one of those dots in the top left represents buying when the market was expensive and then getting a lousy return. And all those dots in the bottom right, that's buying cheap and being handsomely rewarded. The message could not be clearer. Okay, this next idea is a huge mental shift. But once you really grasp it, it will separate you from 90% of other people in the market. It's all about understanding the difference between real danger and just noise. So here it is, the key. Wall Street will tell you that risk is volatility, the ups and downs. A value investor knows that is completely wrong. Real risk is the chance of a permanent loss of your money. It's the business you own actually failing. Volatility, that's just the market having a mood swing. And for the prepared investor, those mood swings aren't a threat. They're a gift. They are the source of all opportunity. Let's just take 1 week, right from the heart of the 2008 crisis. On Monday, total panic. The market tanks. Wednesday, even more panic. Another huge drop. It feels like the world is ending. If you sold then, you were reacting to volatility. But look what happened next. A massive surge on Thursday and Friday that completely erased the week's losses. The person who sold on Wednesday confused the storm for a shipwreck, and they locked in a devastating loss right before the rescue arrived.
So we have the philosophy, but just knowing the rules, well, it's not enough. Now we have to identify the wealth-destroying traps that cause even the smartest people to fail.
The number one trap, the single fastest way for a smart person to go completely broke is leverage, investing with borrowed money. Now, why is that? Because it introduces a ticking clock. It takes the power completely out of your hands, and it can force you to sell at the absolute worst possible moment, turning a recoverable dip into a financial death sentence. And here's the brutal, brutal math of margin. Let's just walk through scenario 1, nice and slow. You start with $1 million of your own money, you're feeling confident, so you borrow another $500,000 to invest, a total of $1.5 million. Then boom, the market drops by a third. It's a tough hit for sure, but it should be recoverable. Your total portfolio is now worth $1 million. But here's the problem. You still owe that $500,000 back plus interest. After you pay it, you are left with less than half of what you started with. A 33% dip just became a catastrophic 53% loss of your capital. And that is exactly how leverage wipes you out. All right, the next trap is this disease of relative performance. This is the crazy idea that if the market falls 20% and you only fall 15%, you've somehow won. A true investor finds this absolutely absurd. Your goal is not to lose less money than your neighbor. Your goal is to make money, period. That's an absolute return mindset. The alternative is just, as one economist put it, failing conventionally. Yeah, you're still losing, you just have a lot of company.
Okay, let's bring this all home. Let's forge everything we've talked about into a final actionable framework. This is the culmination of the entire philosophy.
So what are the pillars of this entire way of thinking? Number 1, you are a business owner, not a ticket holder. Number 2, market panic is not your enemy, it is your greatest opportunity. Number 3, your profit is determined the day you buy, not the day you sell. And number 4, never, ever, ever play a game where you can be forced out. Internalize these 4 ideas and you are well on your way.
And so in the end, every time you think about putting your hard-earned money to work, it all just boils down to this one simple question. Are you buying a piece of a business, or are you just betting on a price? Your answer to that question will determine whether you are building a foundation for long-term wealth, or if you're just rolling the dice.
You know that feeling, staring at a screen of thousands of stocks, trying to find the next big thing? It feels like searching for a needle in a haystack, right? It's just overwhelming. But here's a thought. What if we're looking for the wrong thing? What if the real treasure isn't a great stock, but a great investment? And trust me, there's a huge difference. So today, that's what we're going to do. We're going to build a simple, repeatable process to find those hidden gems. So let's kick things off with a really powerful idea from the man himself, Warren Buffett. I mean, think about it. We're just bombarded with hot tips and market noise every single day. It's so easy to get lost in all that chatter. But your most valuable asset, the one thing that'll set you apart, it's your own independent thinking. And that's exactly what this is all about, building a framework to sharpen that skill.
Okay, so here's our game plan. First up, we're going to really nail down that crucial difference between a great stock and a great investment. Then, and this is a big one, we'll talk about where not to look. And believe me, this is a total game changer. After that, we'll dive into the amazing shortcut of cloning the best investors. I'll show you some practical tools for your toolkit. And finally, a surprisingly simple, advanced strategy. Sound good? Let's get into it.
All right, this right here might be the single most important concept we talk about today. It sounds so simple, but it trips up so many investors. You could find the best, most innovative, most dominant company on the entire planet, but if you pay too much for its stock, you've made a bad investment. Period. The price you pay is, well, it's everything.
In this slide just makes it crystal clear. Let's take Google. I mean, what a fantastic company, right? An absolute cash machine. But at one point, its PE ratio was a whopping 42. So, what does that actually mean in plain English? It means you had to pay $42 for every single dollar the company earned. Now, if you flip that around, that's an earnings yield or return of just 2.4%. Here's the kicker. At that exact same time, you could buy an ultra-safe U.S. Treasury bill, basically the safest investment on earth, and get paid over 3%. So you'd be taking on all the risk of owning a stock for less reward than you could get from the government, guaranteed. And that, my friends, is the difference between a great business and a great investment. So the mission is clear. We're hunting for great businesses at fair prices. Simple enough. But before we even start the search, we need to talk about where not to look. And honestly, this might be the most crucial part of the whole strategy. And we're going to start with the #1 biggest source of bad ideas out there, the financial media.
I mean, just look at this headline from back in 1979. The death of equities. The mood in the country was just awful. Inflation was through the roof, and pretty much everyone was convinced that stocks were done for good. And this wasn't some random blog post, you know? This was the cover of a major business magazine. This was what everyone believed.
And get this, on the exact day that article was published, the Dow Jones Industrial Average closed at 875. Just let that number sink in for a second. 875. The so-called experts were officially throwing in the towel on the stock market at that level. So, what do you think happened next? Well, what happened next was only one of the greatest bull markets in history. The 1980s were an absolute rocket ship. The Dow just soared, going from that low of 875 all the way to over 2,700 by the end of the decade. Anyone who actually listened to those experts in their whole death of equity story, they missed out on a massive, life-changing wave of wealth creation. And here's the big lesson in all of this. The media, they report on what's happening today. The market, on the other hand, is an anticipatory creature. It's always looking ahead to tomorrow. By the time a story is plastered all over the front page, the smart money is already gone. So yeah, use the media to stay informed, to know what's going on, but never ever let it tell you where to put your money. Okay, let's move on to a powerful and, yes, totally legal shortcut. You know, back in school, copying someone else's test was called cheating, right? Well, in investing, it's actually a brilliant strategy. I mean, why on earth would you try to sift through thousands of stocks from scratch when you can just start with the curated picks of the world's absolute best investors? The power of this is just incredible. Just look at these numbers. A study found that if you had simply copied Warren Buffett's public stock picks, and get this, after he had already bought them, you would have made an average return of 24% a year. For 30 years. That's more than double the market's average of 11%. I mean, it's so simple, a monkey could have done it. That's the staggering power of cloning. And you know what the best part is? It is super easy to do. In the US, all the big-time investors are required by law to report their stock holdings every single quarter. It's all public information, and it's all totally free.
You just hop on over to the SEC's website, search for an investor you admire, like Buffett's Berkshire Hathaway, for example, and pull up their latest 13F filing. It really is that simple.
And this is what one of those 13F filings actually looks like. See, it's just a straightforward list of stocks, the number of shares they own, and the total value. There are no secrets here. There's no magic black box. It is literally a shopping list from some of the best investors in the world. This is probably the single best place for you to start hunting for ideas.
So yeah, cloning is a fantastic starting point, but eventually you're going to want to find your own gems. That's part of the fun of it all. So let's look at some practical tools you can use to help you go from being a passive copier to an active hunter of value.
Okay, first up, there's something called the Magic Formula. It's a free online tool created by the legendary investor Joel Greenblatt. Now, yeah, the name's a little bit goofy, I'll give you that, but the logic behind it is absolutely solid. It automatically scans the entire market for two really simple things: good businesses and cheap stocks. It's just a simple, brilliant way to find quality companies that might be on sale. Next up, we've got Valuation. Now, this is a highly respected, kind of old-school research firm. It is a subscription service, but here's a little pro tip for you. You can often get full access for free just by using your local library card. And they have some fantastic pre-made screens, like the ones you see here, that are just perfect for finding all sorts of potential value stocks. Another great place to hunt for bargains? The 52-week low list. This is where you find the beaten down, the unloved, the forgotten stocks. And you know what? That's often where the best deals are hiding. But you have to be careful. You got to watch out for what we call value traps. These are stocks that are cheap for a very, very good reason, usually because the business itself is fundamentally broken. Remember, a low price doesn't automatically mean it's a good deal.
And hey, please don't forget about the most powerful tool you have, your own common sense. I mean, the great investor Peter Lynch, he found some of his best investments just by paying attention to his daily life. The story goes, he invested in Taco Bell just because he loved their burritos. So look around you. The products and services that you and your friends genuinely love, well, that could be your next big investment right there.
All right, so we've covered some fantastic shortcuts and tools. But now, let's talk about the single most powerful search strategy of them all. And what's so fascinating is, it's not advanced because it's complicated or hard to understand. No, it's advanced because so few people are actually willing to do it. The secret is time. The ultimate edge in investing comes from the hard, unglamorous, devoted work of just researching companies, one by one. When someone asked Buffett for his secret, his advice was simple: start with the letter A. And he wasn't kidding. There is simply no substitute for rolling up your sleeves and just doing the work. And Buffett's investment in South Korea is a perfect example. He was handed this massive manual of Korean stocks, thick as an old phone book, and he just read the whole thing, page by page. And he found these simple, durable businesses, like he says here, making basic stuff like steel and cement that people are definitely still going to be buying in 10 years. And he realized they were selling for incredibly cheap prices. No secret formula, just hard work and a dedication to reading.
Okay, we have covered a lot of ground. We've gone all the way from the core philosophy of what actually makes a great investment to practical, actionable strategies you can use right now. So let's bring it all together into a clear action plan for you to take forward.
So here's your path forward. Number 1, start by imitating the best. It really is the smartest shortcut. 2, let the media inform you, but never ever let it guide you. 3, use those powerful tools we talked about to find ideas, not to get a ready-made buy list. 4, read constantly. Read everything you can get your hands on. And most importantly, the number 1 rule, always do your own homework.
Look, in the end, finding great investments, it isn't about some secret password or a super complex algorithm. It's really about having a solid process, a curious mind, and the discipline to actually see it through. The strategies themselves are surprisingly simple, but putting them into practice consistently, well, that's not always so easy. So, you have the map now. The only question left is, are you willing to take the journey?
All right, have you ever looked at legendary investors like Warren Buffett and just thought, how do they do it? How do they always seem to find these amazing companies before anyone else? Well, I'll tell you, it's not some kind of magic. It's a method. And in this explainer, we're going to pull back the curtain on that exact method so you can start thinking just like they do.
This might sound surprising, but the secret here isn't about having a supercomputer or some crazy complex algorithm. The best investors in the world, they just focus on a few core, timeless ideas.
And today, we're going to walk through exactly what those are, and more importantly, how you can start using them.
So here's our game plan. We're going to start with the big picture philosophy. Then we'll get our hands dirty with the actual tools you need to value a company. We'll even do a real-world case study so you can see it all in action. And we'll wrap it all up with a simple playbook for you to take with you. Sound good? Okay, let's dive in.
Okay, first up, when you're trying to figure out what a business is worth, it is so easy to just drown in numbers and data. The real secret? It's about ignoring almost everything and focusing on the handful of things that truly matter. You know, for an oil company, it's really all about production levels and the long-term price of oil. That's it. The key is to find those few critical drivers for any business you look at.
Now we get to what I think is the single most important concept in all of value investing. Seriously, this is the bedrock, the foundation of everything. It's the one rule that can protect you from making huge mistakes, and honestly, it's the key to being able to sleep at night even when the market is going completely haywire.
So what are these three words? According to the man himself, Warren Buffett: margin, of, safety.
Think about it like this. If you were an engineer building a bridge that needs to hold 10 tons, you wouldn't build it to hold exactly 10 tons, would you? No way. You'd build it to hold 20 or 30 tons. That extra capacity, that's your margin of safety. It's your buffer for error, your protection against the unknown. Because in investing, the one thing you can count on is that you can't predict the future perfectly.
And this is a really crucial mindset shift. A margin of safety forces you to stop thinking only about the return on your capital, the profits, and to start thinking first about the return of your capital. In other words, before you even dream about the upside, you make darn sure you've protected the downside. Rule number 1, don't lose money. This is how you do it.
Okay, so this all makes sense, right? We need to buy things for less than they're worth. We need a discount. But that leads to the obvious next question. A discount to what? How in the world do you figure out what something is actually worth in the first place? Well, that leads us right to the next piece of our puzzle.
And that what is what value investors call a company's intrinsic value. Think of the daily stock price as the emotional, crazy roller coaster. The intrinsic value is the solid ground underneath it all. It's what the business is fundamentally worth, totally separate from the market's mood swings.
So how do we find this intrinsic value? It all comes down to one word: cash. Not reported profits, not earnings per share, which, let's be honest, can be messed with. We're talking about cold, hard cash, the actual money a business generates that you could, theoretically, put in your pocket. Because cash doesn't lie. And this slide just illustrates the whole concept perfectly. Look, on the left, you've got a pretty safe investment. On the right, a business that's a real cash machine. Now, even if they both cost the exact same amount to buy today, it's a no-brainer which one is actually worth more over the long haul, right? The more cash a business can pump out, the more it's truly worth. It's that simple.
Okay, enough theory. Let's get our hands dirty and see how this all works in the real world. We're going to roll up our sleeves and walk through step by step how you'd actually value a real company. In this case, Ensco Corp.
So, the very first thing we need to do is figure out how much real cash Ensco is generating. And to do that, we calculate something called free cash flow. It sounds technical, but it's really not. All you do is take the cash that comes in from running the business and subtract the cash they have to spend just to maintain the business. What's left over is free for the owners.
And the best part is, you don't have to guess these numbers. Every public company has to publish them in what's called a cash flow statement. You literally just look for 2 lines. As you can see right here, cash from operating activities and capital expenditures.
So you do that simple bit of subtraction, and then, wow, look at this. You can see the story unfold. Just a few years earlier, Ensco was actually burning through cash. But in just 4 years, it turned into an absolute cash-generating machine, gushing over $722 million. That is the kind of powerful trend that makes an investor sit up and pay attention.
Okay, so the next step involves a little bit of forecasting. We have to make some conservative, educated guesses about how much cash the company is going to generate over the next 5 years or so. And then, and this is key, we have to discount those future dollars back to what they're worth today. Because a dollar you're promised in 5 years is worth less than a dollar in your hand right now, right?
So we take all those discounted cash flows, add them all up, and then we add a final number for what we think the business will be worth far down the road. You put all those pieces together and you land on a number.
Our best estimate for the intrinsic value of Ensco comes out to about $51 a share.
And this is the magic moment. This is the payoff. Our analysis says the business is worth 51 bucks, but at the time, you could buy it on the stock market for just 35. That huge gap between our calculated value and the market price, that is our margin of safety. And that's what signals a potential opportunity.
So we've done our homework on the business itself, the ship, so to speak, and it looks pretty solid. But what about the captain, the people running the company? How much does the quality of management really matter? Well, let's see what Warren Buffett thinks about this one.
What Buffett is saying here is pretty blunt. A rock star CEO cannot save a fundamentally terrible business. If you put a brilliant manager in charge of a sinking ship, the ship is still going to sink. It's the quality of the business itself that wins out in the end, every single time.
And this quote just drives the point home perfectly, doesn't it? He's basically saying, look for a business that is so strong, so durable, that it can survive even mediocre leadership, because sooner or later it probably will have to. Think of great management as the icing on the cake. It's fantastic to have, but you've got to make sure the cake itself is good first.
We have covered a ton of ground here. So let's take a moment and boil all of this down into a simple, actionable playbook that you can start using right away.
So here it is, your value investing checklist. Number 1, always demand a margin of safety, non-negotiable. 2, remember that intrinsic value is an estimate. It's an art, not a precise science. 3, look for businesses that have a real, durable competitive advantage, something that protects them. 4, the quality of the business is way more important than the quality of the management. And 5, if you want to judge management, look at the track record of growing the real underlying value of the company.
You know, at the end of the day, anyone can see a stock's price. It's flashing on screens everywhere all day long. But a business's value? That's hidden. That's something you have to dig for. But now, you have the tools to start digging. So the only question left is, where are you going to start your search?
You know, when we talk about what makes a great investor, we usually hit the big three, right? Find a great company, buy it at the right price, and make sure you have a margin of safety. But there's this fourth element, one that's a lot less about spreadsheets and more about what's going on in your head. Discipline. Today, we're going to dive into why the simple, powerful act of saying no might just be the most important tool in your entire investing toolkit. I mean, Benjamin Graham, the guy who literally wrote the book on value investing, just nails it with this quote. It's not about being the smartest person in the room. Nope. In fact, being too smart can sometimes be a trap. The real fight, the thing that truly separates the good from the great, is having the raw willpower to stand your ground when the entire crowd is running in the other direction. Okay, let's make this real. Picture a really sharp investor. They've done all the homework on a company and figure its true value is about $25 a share. But then the market goes wild and the stock shoots up to $35. That little voice in their head, the fear of missing out, FOMO, starts screaming. So they throw their own research out the window and buy in. And what happens? Almost instantly, the stock tumbles right back down to the $25 they knew was the right price all along. So now, this person feels like an idiot. But here's the thing. Their mistake had zero to do with their IQ. It had everything to do with a failure of discipline. Their emotions totally hijacked their logic, and they paid for it. This is the big battle every single one of us faces as an investor. And learning how to win it, well, that's everything. All right, so here's how we're going to break this all down. First, we'll talk about the intelligence trap. Then we'll get into the absolute core concept of price, not value. After that, we'll look at the courage it takes to be a contrarian, why you shouldn't split hairs, and finally, how it all comes together when you're playing the long game. So first up, the intelligence trap. This is going to sound a little weird, but investing is one of those rare fields where once you get past a certain basic level, being smarter doesn't actually mean you'll get better results. Sometimes it can even hurt you. What really takes over is your temperament, your discipline. Think about it like this. Think about baseball. The difference between a totally average hitter and a guy who ends up in the Hall of Fame, it's just 5 extra hits for every 100 times at bat. Just 5%. It's that tiny, consistent edge that makes all the difference. Well, investing is kind of the same. You don't have to be perfect. Heck, you can be wrong more often than you're right and still get incredible Hall of Fame results. So how is that even possible? Well, the answer comes down to one thing: unwavering discipline. That's the secret sauce. It's the discipline that makes sure that when you win so big that it completely wipes out all your losses, and then some. Discipline is what makes a loss a calculated learning experience instead of just a dumb emotional mistake. It's all about the process. And that idea of a disciplined process leads us right into our next big topic, understanding the absolute core mantra of price, not value. This is probably one of the most fundamental ideas in investing, but it's also one of the easiest to get wrong. You've probably heard the saying, price is what you pay, value is what you get. It's so simple, right? But it's also incredibly profound. See, your profit isn't made when you sell a stock. It's locked in the moment you buy it. The price you pay is what dictates your margin of safety and your potential return. Getting this part right is, well, it's the whole game. But this leads to a really common trap. Our brains are kind of wired to see a lower price and think, ooh, that's the better deal. But is it really? How in the world can a stock that costs $52 a share actually be a better value than a similar company's stock that's trading for half that price at just $26? Well, this slide gives us a perfect real-world example from back in December of 2008. We're looking at two energy companies, ConocoPhillips, which was trading at $52, and Cabot Oil and Gas at just $26. On the surface, Cabot looks cheaper, right? But let's pop the hood and see which one was actually the better deal. So even though Cabot had the lower price tag, ConocoPhillips was the hands-down winner when it came to actual value. It had a way lower price-to-earnings ratio, which means you were paying a lot less for every dollar of profit the company made. It was a cash-gushing machine, while Cabot was actually losing cash. Oh, and it was paying a pretty sweet 3.7% dividend. The sticker price, as you can see, is just a tiny part of the real story. Okay, so this brings us to the really tough part, the psychological core of all this, the contrarian's courage. Because real discipline means having the guts to go against the herd, to say no when literally everyone else is screaming yes. And that, my friends, often means you have to be willing to look really, really stupid for a while. This is just a perfect story of that courage. So Warren Buffett's personal tutor for all things tech was Bill Gates, the best you could possibly get. For years, Gates explained the whole industry to him. Buffett got it. He understood how dominant Microsoft was. And yet, he said no. He refused to make a big investment. Why on earth would he do that? The answer is simple. He had the discipline to stay within what he called his circle of competence. Now, a lot of people will look at that and say, think of all the money Buffett lost by not buying Microsoft. But the real genius is when you flip the argument around. Think about all the mistakes in tech he didn't make because he stayed disciplined. Those avoided losses were probably way bigger than any single win he might have missed. And here's the crucial point. This discipline is a two-way street. A disciplined investor isn't going to panic and dump a great company just because there's a little bit of bad news. And that same disciplined investor is going to have the strength to say no thank you to the latest hot stock that everyone is chasing. It's about having conviction on one hand and restraint on the other. But, and this is a big but, discipline isn't the same thing as just being stubborn. This brings us to a more nuanced idea. Don't split hairs. Because sometimes the most disciplined thing you can do is actually take action, instead of waiting around for some perfect moment that might never show up. Okay, check out this scenario. Investor A buys a stock for $50. It immediately tanks, dropping 50% to $25, and it just sits there for a whole year. Investor B sees this, thinks it's a bargain, and buys in at the rock-bottom price of $25. Over the next couple of years, the stock roars back to $80. So, Investor B doubles their money, while Investor A gets a decent but smaller return. Who was the smarter investor here? And here's the big reveal. Investor A was Warren Buffett buying stock in the Washington Post back in 1973. Yeah, he was early. He had to watch his investment get chopped in half. But his analysis of the business itself, its long-term value, was spot on. The lesson here isn't about perfectly timing the market. It's about getting the valuation of the business right. And that's the key difference. A truly disciplined value investor doesn't try to time stock prices. They price stocks. They figure out what a business is worth. Trying to catch the absolute lowest point is a fool's game, and it distracts you from what really matters, doing solid research on the company. This table here really shows the silliness of what's called anchoring, when you get obsessed with a very specific price. Let's say you valued a stock at $33, and you think, I'm just going to wait for it to dip to $32, but then it never does. Instead, it takes off and goes to $60. Look at this. You would have given up an 82% return just because you were chasing a slightly better 88% return. Is that tiny difference worth the risk of missing the whole thing? No way. In all of these pieces, dodging emotional traps, focusing on value, having that nuanced discipline, they all lead us to our final and most important point: playing the long game. Benjamin Graham had this famous saying that in the short run, the market is a voting machine, but in the long run, it's a weighing machine. And this slide is just a beautiful illustration of that. Take a fantastic company like Apple. If you bought their stock in 2000, you're probably feeling pretty terrible 3 years later after the dot-com bubble burst. The voting machine was just punishing every tech stock. But if you had the discipline to hang on, the weighing machine eventually kicked in. The market recognized the true fundamental value of the business, and the stock price reflected that, leading to absolutely incredible returns. So I'll just leave you with this one question to think about. The next time you're looking at an investment and you feel the pull of the crowd, just stop for a second. Ask yourself, am I just casting a vote here based on popularity and what everyone else is doing? Or am I taking the time to actually weigh the real long-term value of this business? Your answer to that question will make all the difference in the world. All right, let's talk about a secret weapon in the world of finance. One that pretty much goes against everything you see flashing on your screen: patience. We're going to challenge this modern obsession with speed, with constant activity, and show you exactly why, in investing, doing less can literally make you more. You know, this quote from the philosopher Blaise Pascal might seem a little out there, but trust me, it gets to the heart of a really expansive truth about investing. Our inability to just be still, to sit quietly with our thoughts and our decisions, that's where so many of our biggest mistakes come from. It's that constant itch, that feeling that we have to do something, that gets so many people into trouble. So, here's the game plan. First, we're going to pull back the curtain on what I call the cult of speed in finance. Then we'll introduce the secret fifth element that makes value investing actually work. We'll dig into the surprising power of doing nothing, learn how to spot that perfect opportunity, and finally, we'll see how it all comes together to create a winning philosophy. Okay, let's get right into it. To really appreciate why patience is such a superpower, you first have to understand what we're up against. The entire modern financial system, it's basically an engine designed to make you feel like you're always behind, always needing to react. Think about it. Have you ever watched a financial news channel and seen that little clock they have in the corner, the one ticking away in hundredths of a second? It's kind of hypnotic, right? The numbers are flashing, the tickers are scrolling. But what possible rational use does that have for a serious investor? The answer is absolutely none. It's pure theater, designed to get your adrenaline pumping and push you into making a move. Any move. And what all that chaos does is create two fundamentally different kinds of people. On one side, you have the speculator. They get sucked right into the adrenaline rush. For them, it's all about the market noise, the thrill of the trade, trying to time everything perfectly to make a quick buck. But on the other side, you have the value investor. They're playing a totally different game. They see themselves as a business owner. Their number one job is to protect their capital. And they understand that stocks aren't just blinking lights, they're pieces of actual businesses. And that brings us right to the heart of this whole thing. For the value investor, patience isn't just about sitting on your hands and waiting around. No way. It's an active, powerful, and absolutely critical strategic tool. It's the secret ingredient, the fifth element, that separates the good from the truly great. So where does patience fit in? Well, it's a pillar of this whole philosophy of value investing. You can think of value investing as being a financial detective. You're not just running with the panicked herd. You're doing your own deep, fundamental investigation, looking for clues others missed, and you're making your decisions based on cold, hard facts, not on emotion. And here's the crucial part. You can have all those other four elements down pat. You can be the world's best analyst, have a rock-solid long-term plan, and be a fearless, independent thinker. But without patience, it's all basically useless. Patience is the catalyst. It's the element that gives your analysis and your long-term view the time they need to actually pay off. Now, this is where it gets really fun and honestly a little counterintuitive. It's going to sound strange, but one of the most profitable, most powerful things you can do as an investor is nothing. That's right, we're about to look at the hard evidence for how disciplined inactivity can actually make you way more money. Warren Buffett has this brilliant baseball analogy to explain this. He says investing is like a baseball game with one huge game-changing difference. See, in baseball, if the perfect pitch comes right through the strike zone, the umpire forces you to swing. But in investing, you can stand at the plate all day long and watch hundreds of pitches go by, overvalued companies, crazy speculative fads, stuff you just don't understand. And guess what? There are no called strikes. You have the incredible luxury of waiting indefinitely for that one perfect slow pitch right in your sweet spot. And the real-world benefits of this sitting-still approach are massive. First off, you save a ton of money. Every time you buy or sell, you're paying your broker, so fewer trades means more money in your pocket. Second, and this is a big one, you let the power of compounding run wild. By not selling winners, you defer capital gains taxes, which means more of your money stays invested and working for you. And third, you just make fewer stupid mistakes. Most of our worst investment decisions happen on impulse, when we let fear or greed take over. So just how much is this doing nothing worth? Well, the math shows that just the tax deferral advantage alone is worth about 3% a year. Now, 3% might not sound like a huge number, but get this. Research from Vanguard's founder, John Bogle, showed that 99.5% of all professional mutual fund managers fail to beat the market by that much over the long haul. You can get a massive edge just by sitting on your hands. If you're still not sold, let me tell you a quick cautionary tale. It's about a hedge fund from the 90s called Long-Term Capital Management, or LTCM. This place was run by a room full of certified geniuses. I'm talking Nobel Prize winners, top PhDs from the best schools. They had these super complex models, and for a little while, they made a fortune. But then they got impatient. They got arrogant. And they used so much leverage that when one of their bets went wrong, they blew up in the most spectacular fashion, nearly taking the entire global financial system down with them. And that whole disaster is the perfect, if really painful, illustration of what Warren Buffett is saying here. It's not about having a 200 IQ. The guys at LTCM prove that. Once you're past a certain point, what really separates the winners from the losers is temperament. It's having the emotional discipline to control those destructive urges that scream at you to do something when the smartest move is to just do nothing at all. So, we've talked a lot about why we need to wait. But the big question is, what are we actually waiting for? What does that fat pitch Buffett talks about really look like in the wild? Well, it usually comes down to one of two big opportunities. The first path is like finding a dollar bill on sale for 50 cents. You're literally buying a company's assets for less than they'd be worth in a fire sale. The second path, which is more common, is what I call the plant a tree approach. You're buying a wonderful, high-quality business that's going to grow for years and years, and you're just patiently letting it do its thing. Let me show you what I mean with that first path. Way back in the middle of the 2008 financial crisis, there was this shipping company called Dry Ships. Now, their stock was trading for just $3 a share. But if you glanced at their balance sheet, their stated book value was a whopping $49 a share. That looks like buying a $10 bill for 60 cents. Seems like a total no-brainer, right? The fattest pitch you've ever seen. But hold on. A patient investor doesn't just take that number at face value. They put on their detective hat and start asking hard questions. They say, okay, but what are these giant cargo ships really worth during a global recession when nobody is shipping anything? They get out a big red pen. They conservatively slash the value of the fleet. They see an accounting line item called goodwill and know that's basically imaginary, so poof, that gets marked down to zero. And after all that skeptical, patient work, you get a much different number. The real conservative liquidation value was closer to $7 a share. Now, that's still a potential bargain against a $3 stock price, but it's not the slam dunk it looked like at first. That's patient analysis. Okay, so now let's talk about that second path, the plant a tree strategy, also known as GARP, or growth at a reasonable price. This is where some of the biggest fortunes in history have really been made. It's about finding a truly great company, a powerhouse like Johnson & Johnson, and letting the magic of compounding do the heavy lifting for you. It's the most powerful force in finance, bar none. And get this, if you had bought just one single share of Johnson & Johnson back in 1944 for about $37, and you just patiently held on, reinvesting those dividends along the way, 60 years later, that one share would have grown to be worth almost $1 million. That's an annualized return of over 17%. That is the mind-blowing power of finding a great business and then having the patience to just let it work. And it's not just a one-off story. Just look at some of Buffett's most famous investments here. This is not a list of quick flips. Look at this. Coca-Cola, bought in 1988. The Washington Post, 1973. American Express, all the way back in 1964. The secret here isn't some complex trading system. It's finding a fantastic business, buying it at a fair price, and then having the discipline to let it work for you for decades. So when you put all these pieces together, what do you get? Well, it means that patient investors aren't just using different tactics. They're playing a completely and fundamentally different game than almost everyone else in the market. They're not trying to win today's news cycle. They're playing for keeps. They're playing the long game. So, if you remember anything from our time together, let it be these key takeaways. First, over the long run, the stock price always catches up to the real value of the business. Second, patience is your best friend. It cuts your costs and saves you from your own worst impulses. Third, having cash on the sidelines isn't a failure. It's a strategic weapon, ready for that perfect opportunity. And finally, remember that real money is made when you buy, not when you sell, by finding a great company at a great price. I'm going to leave you with one last thought from Benjamin Graham, the father of value investing. He said, "The stock market is there to serve you, not to guide you. You can use its crazy mood swings to your advantage, buying when it's terrified and selling when it's euphoric. Or you can let its moods control you, getting swept up in the noise and becoming its servant." So the final question you have to ask yourself is this: who's in charge? Are you its master or are you its servant?
You know, what if I told you that the real secret to successful investing isn't about chasing the hottest stocks that everyone's talking about, but actually running toward the ones that people are practically giving away in a panic? It's a completely backwards idea, I know, but it is absolutely key to finding those incredible returns. So let's get into it.
This quote from the legendary investor Sir John Templeton, man, it just perfectly captures everything we're about to talk about. It's not just some clever line. It's literally a roadmap of how markets and people's emotions work. The entire philosophy here is built on this one idea. The absolute best deals are hiding in plain sight. They're just disguised as really, really bad news.
And right there, that's the billion-dollar question, isn't it? If this advice is so powerful and has been proven time and time again, why do we constantly see people piling in at the top when things are euphoric and then panic selling at the bottom when things look terrible? Well, the answer is hardwired into our own human nature, and figuring that out is the first step to beating it.
All right, so here's the game plan. We're going to start with the psychology that drives all of this, the greed and the fear. Then we'll define exactly what we mean by maximum pessimism. After that, we'll lay out the disciplined framework you need to actually do this, look at some amazing historical examples, bust a few common myths, and then wrap it all up with the 4 truths you absolutely have to live by.
All right, first step, the 2 big emotions that pretty much run Wall Street, and if you're not careful, your own bank account. This is all about the tug-of-war between greed and fear, and how the psychology of the crowd can be the single most dangerous thing for your money.
And of course, who else but Warren Buffett just nails it with this one. Look, this isn't about being different just to be different. It's a strategic move. It's about deciding to be the rational one in the room when everyone else is being driven by pure, raw emotion. It's about completely flipping the script on your natural instincts. And think about it. This makes perfect sense. In almost every other part of your life, going with the group is a good thing. It's a survival mechanism. It feels safe. But in the world of finance, that same instinct to just follow the herd, whoa, that can lead you right off a financial cliff. The consensus is almost always wrong at the absolute worst possible time. Okay, so that leads us right into the core concept of this whole thing, maximum pessimism. This is that magic moment when opportunity is at its absolute highest, but the perceived risk, what it feels like, is through the roof. This is where fortunes are made by the people who can see through all that noise.
So what does this point of maximum pessimism actually look like? Well, it's that moment when every headline is screaming doom and gloom, when your friends and family are telling you they're finally getting out of stocks for good, and when the very thought of putting money into the market sounds completely insane. That's the moment we're talking about.
Now, this is where things get really fascinating, because this question just highlights the complete paradox of human emotion in investing. Logically, getting a bigger discount, buying that dollar for 35 cents, should feel safer, right? It's a better deal. But psychologically, the falling price that got it down to 35 cents triggers all our fear of loss alarms, and it makes the better bargain feel way, way scarier. It's that exact irrationality that a smart investor can use to their advantage.
So the big question is, how do you actually build up the nerve to buy when everyone else is running for the exits? Look, it's not about being a daredevil or a gambler. It's about having a rock-solid foundation, a framework that gives you the confidence to act when your gut is telling you to hide. These 5 pillars, they are the whole foundation. First, you gotta have the right philosophy. You're buying a business, not a lottery ticket. Then, you need a strategy for finding ideas and the skill to figure out what they're actually worth. But honestly, the last 2, discipline and patience, those are the real killers. They have nothing to do with spreadsheets and everything to do with your own temperament.
And check this out. Legendary investor Seth Klarman takes it even further. He suggests these traits might just be hardwired into you. It's this idea that when you first hear about value investing, it either just clicks and makes perfect intuitive sense to you, or it sounds like complete nonsense. It's a mindset you can't really force.
Okay, enough theory. Does this stuff actually work in the real world? Let's look at the receipts. History is just littered with these incredible stories of investors who made absolute fortunes by applying these exact principles during the absolute worst times. This is one of my favorite stories in investing history. It's 1939, Hitler's invading Poland, the world is on the brink of World War II. Absolute maximum pessimism. And what does John Templeton do? He borrows 10 grand and buys 100 shares of every single stock on the US exchanges, trading for under $1. People thought he was insane, but his logic was so simple. At this point of total desperation, the only way for most of these companies to go was up. And, well, the results speak for themselves.
Negative 22.6%. Just let that sink in for a second. That's how much the market fell in a single day back in 1987 on Black Monday. It was pure, unfiltered panic. But here's the question. Did the actual value of America's best companies really drop by almost a quarter in one day? No way. For value investors, this wasn't a crisis. It was a Black Friday sale. Okay, so let's flip this on its head for a second. If buying pessimism is so great, what about buying maximum optimism? What happens if your strategy is just to always buy the most popular, most beloved, and most valuable company out there? I mean, it feels safe, doesn't it? Well, let's see what the data says. So what you're seeing here is a list of the most valuable company in the US year by year from 87 to 2002. You see all the big names, IBM, Exxon, GE, Microsoft. The idea would be to sell last year's winner and buy this year's winner. You're always chasing what's popular, what's at peak optimism. And the results? Yikes, they were not good. This buy the winner strategy returned a measly 3.3% a year, which got absolutely crushed by just buying a simple S&P 500 index fund. It's such a powerful lesson. By the time a stock is the darling of Wall Street and everyone loves it, you're probably already late to the party. You're paying for popularity, not for value. All right, now because this whole idea is so, well, weird to most people, a bunch of myths have popped up around it. So let's do a little myth busting and clear up some of the biggest misconceptions about value investing. First up, this idea that value investors just sit around on piles of cash for years, just waiting for a massive crash before they do anything. Is that really how it works? Yeah, that's not it at all. A true value investor is always on the hunt for a good deal. The only thing that matters is finding a gap between the price of something and what it's actually worth. Think of it this way. A bear market is just like a store-wide clearance sale. The bargains are just way easier to find, but you can find individual items on sale at any time.
Okay, let's tackle another big one. Short selling, which is betting that a stock is going to go down, seems like the total opposite of long-term value investing. Is that something a value investor would ever even consider?
For the most part, no. And the reason is that the math is just scary. When you buy a stock, the most you can possibly lose is the money you put in, right? But your potential gain is unlimited. When you short a stock, it's flipped. The most you can make is 100%, but your potential loss is infinite. That's a dangerous game to play.
But, and this is a big but, there are moments of pure, unadulterated madness in the market. Think about the tech bubble back in 2000, when the average price-to-earnings ratio of the NASDAQ hit an absolutely insane 245. In moments like that, when valuations become completely unhinged from reality, the most value-oriented decision might actually be to bet against the euphoria.
Okay, we have covered a ton of ground. We've talked psychology, principles, proof, and we've busted some myths. Now let's boil it all down to the 4 absolute, non-negotiable truths that really define this whole mindset.
This is really the final gut check. You got to ask yourself these questions. 1, do you actually understand the business? 2, does a falling stock market make you excited, or does it make you sick to your stomach? 3, is your first thought, how could I lose money here, instead of how much can I make? And 4, are you willing to go looking for treasures in the places everyone else has written off as junk?
If you can say yes to all of these, you've got it. And I want to leave you with this one last, really powerful thought from the godfathers of value investing, Benjamin Graham and David Dodd. What they're saying here is profound. If you wait for the news to be good, for the market to give you the all-clear signal, you're not an investor anymore. You're just following the crowd. You're a speculator. And the real question this leaves you with is, which one do you want to be?
Welcome to The Explainer. Today, we're going to crack open the playbook of some master investors. We're going to see how they find these incredible bargains in places you would never, ever think to look, and how a totally different perspective can uncover some truly historic opportunities. And you know, we really have to start with this foundational idea from the father of value investing himself, Benjamin Graham. I mean, it's right there on the screen. It's not about speculating, it's not about gambling. It's about a rational, repeatable process of getting more than your money's worth. That's the core principle we're going to see in action today.
So, here's our game plan. First, we'll get into the essential mindset. Then, we'll dive into 3 completely different real-world case studies that really show this philosophy at work. And finally, we'll pull it all together with the key lessons you can actually use.
Okay, let's get into it. The investor's mindset. This is so important. This is the fundamental difference between building lasting wealth and, just getting lucky once in a while. It's all about having a disciplined process that pushes emotion to the side and focuses on repeatable steps instead of just crossing your fingers and hoping for a good outcome.
To really get this, think about golf. An amateur, right, they might go to the driving range and just whack 500 balls. But a pro, someone like Tiger Woods, oh no. He hits those 500 balls with a very specific target and a precise ball flight in mind for every single shot. See the difference? He's not just practicing, he's perfecting a rational, repeatable process. That is the exact same goal for a value investor.
And that brings us to this crucial point here. It's not about chasing the hot, high-flying stocks that everyone's talking about. No. The primary concern is safety. The whole goal is to buy a business for less than it's truly worth. Like buying $1 for 50 cents. The profit you make? Well, that's just a natural result of the market eventually waking up and realizing that true intrinsic value.
Okay, so let's jump into our first case study and see how this mindset uncovers opportunity where everyone else just sees a total disaster. We're going to go back to 2002 to a company called Sunrise Senior Living, which was operating in a sector that the market absolutely positively hated at the time.
So you have to ask, right? Why on earth would an investor go digging around in an industry where competitors are literally going bankrupt? Well, this is where Graham's idea of Mr. Market is just so powerful. Think of the market as this moody, emotional business partner. In 2002, he was in a full-blown panic, punishing the entire assisted living industry and just selling everything off for cheap, even the really good companies. And that panic created a huge opening for a calm, rational investor.
Now, what's so interesting is that when you actually looked past all that industry-wide gloom, Sunrise was a completely different animal. As you can see here, they had a bunch of advantages. I mean, they clustered their facilities in wealthy metro areas, their competition was failing, which meant less supply, they relied on private pay so they weren't at the mercy of unreliable government reimbursements, and maybe most importantly, their target demographic was absolutely booming. These weren't just little things, these were powerful, durable, competitive advantages.
And their business model, as you can see, was this brilliant 2-part engine. First, they were basically a developer. They'd build a facility for, say, around $11.7 million and then sell it for $16 million. But here's the kicker. They held on to the rights to manage the property. This created a second, incredibly stable, long-term revenue stream from all those management fees.
And this is the aha moment. This slide shows the hidden value that the market was just completely missing. So, because of accounting rules, Sunrise had its properties listed on its books at their original cost. We call this book value. But just look at this table of actual sales. On average, they were selling these properties for a 53% premium over that book value. This means the company's real estate was worth a fortune more than what the official accounting statements were showing.
So when you actually did the math, and you can see the summary of that analysis right here, you could combine that hidden real estate value with the value of that steady management business. And what did you find? The stock was trading for around $25 to $30, but its true intrinsic value was way closer to $50. That massive 40 to 50% discount, that is what Graham called the margin of safety. It's a huge cushion just in case your analysis is a little bit off.
Okay, now let's shift gears and look at a totally different kind of opportunity. This one wasn't created by a struggling industry.
but by something that spooks markets even more: widespread geopolitical fear. We're talking about a company called Ternium Steel. So, in 2007, Ternium was an absolute powerhouse. I mean, it was one of the most profitable steel companies in the entire world, with incredible margins and just tons of cash flow. And yet, it was trading at a valuation that was just absurdly, ridiculously cheap. So what was the catch? What was the problem?
Well, the problem could be summed up in one word: Venezuela. See, about a quarter of Ternium's profits came from its assets down there, and the market was absolutely terrified that President Hugo Chavez was just going to nationalize them, seize them for the state. This one single point of fear was causing our old friend Mr. Market to have a complete and total panic attack, punishing the entire company as if those Venezuelan assets were already worthless.
But a rational investor, they don't panic. They run the numbers. So let's look at this table. We're looking at a common valuation metric here. Don't worry too much about the jargon, but the key part is this. In the absolute worst-case scenario, let's say Ternium's Venezuelan assets go to zero, totally worthless. The company would still be trading at a multiple of 5.4. Meanwhile, its competitors were trading at an average of 7. So even if the market's greatest fear came true, the stock was still a bargain.
And this just shows the power of putting actual numbers to a narrative of fear. What you're seeing here is a summary of a valuation analysis. Basically, it's a way to estimate what a company is truly worth. And that analysis suggested the stock's intrinsic value was around $68 to $75 a share. At the time, it was trading for about $30. The margin of safety here wasn't 50%, it was over 100%.
Now, what's really interesting here is how this reinforces a core kind of counterintuitive idea. This slide shows an updated analysis from early 2009. We're talking the depths of a global recession. You can see the cash flow assumptions are way lower. Even so, the stock, which was now trading at just $16, was still worth over $30. This teaches us a crucial lesson. As the price of a good business falls, the investment actually becomes less risky, not more, because your margin of safety just gets wider and wider.
All right, our final case study shows that sometimes the value you find has absolutely nothing to do with the business itself, or its industry, or geopolitics. Sometimes it's just a simple error, a glitch in the market that you can take advantage of.
So this was a pretty special situation involving a company called Mueller Water Products. After a spin-off, it ended up with two different classes of common stock, Class A and Class B. Now, according to all the corporate filings, they were economically identical. Each share represented the exact same claim on the company's assets and earnings. So why on earth would the market put a different price tag on them? I mean, the mispricing was just absurd, as you can see here. In September 2008, the Class A shares were trading for about $9, while the identical Class B shares were at $6. That's a 50% difference for the exact same thing. And what's even crazier is that the Class B shares actually had superior voting rights. So if anything, they should have been worth more, not less.
The trade here was a textbook example of something called arbitrage, which is basically a nearly risk-free profit from a price difference. You didn't even need to have an opinion on the business. You just sold the expensive thing, the Class A shares, and at the exact same time, you bought the cheap, identical thing, the Class B shares. Then you just had to wait for the market to fix its mistake. When the prices eventually came back together, you just pocket the difference. Simple as that.
Okay, so after looking at an unloved industry, a feared geopolitical risk, and a straight-up market glitch, what can we learn? What are the common threads that tie these three very different stories together?
While these cases really reveal the core disciplines in the Value Investor's Toolkit, it's the discipline to actually analyze Sunrise when everyone else was just running for the hills. It's the skepticism to question the market's blind panic over Ternium and to run the numbers for yourself. It's the patience to wait for the market to eventually correct its simple, silly mistake with the Mueller shares. And it's a relentless focus on risk, understanding that the real risk with Ternium wasn't a bouncing stock price, but the actual chance of losing your money forever, a risk that the numbers showed was deeply, deeply mispriced.
And that really is the key takeaway from this whole thing. These principles are absolutely timeless. Market pessimism, whether it's about an industry, a country, or some weird temporary market structure, that is what creates opportunity. The same types of mispricings are out there today for anyone who has the discipline and the courage to actually go look for them. And that leaves us with one final question to think about. Where is Mr. Market most pessimistic right now?
Hey everyone, if you've ever invested, you probably know that feeling, right? You do all the research, you make your move, and then you watch it go sideways. Well, what if the real secret to winning long-term wasn't about finding that one perfect stock, but just about avoiding the same predictable mistakes over and over again? That's what we're talking about today. We're going to build a playbook to do exactly that. Let's get into it. And you really can't start a conversation like this without a little wisdom from Warren Buffett. This quote is just perfect because it gets right to the heart of the matter. See, trying to be perfectly precise when you're investing, well, it's usually a trap. You're dealing with probabilities, with assumptions about the future. It's not a math problem with a single right answer. The goal here isn't perfection. It's about making sound judgments. And this, right here, is probably the most important idea we're going to cover. I mean, think about it. The best, most successful investors in the world, they still make mistakes. Their superpower isn't having a crystal ball. It's that they have built a system, a process, so they are never wrong the same way twice. That's the skill. That's what we're here to break down. Okay, so first things first, we have to embrace this idea of imperfection. You've got to accept that mistakes are just part of the game. I mean, every single investment you make is basically a bet on an unknown future. The economy could shift, a new competitor could pop up, things change in ways no one can predict. You just can't eliminate all the risks. So how do you deal with all that uncertainty? Well, you shift your focus. Instead of obsessing over the short-term outcome, did my stock go up today? You put all your energy into the quality of your decision-making process. Look, a good process isn't going to guarantee you a win every single time, but it is your absolute best defense against making those same really expensive mistakes again and again. All right, so now that we've got our mindset straight, let's get into the specifics. It's time to navigate what is basically a minefield of really dangerous traps that can catch anyone off guard, even seasoned investors. There are 3 big ones to watch out for. First, chasing those quick, flashy gains instead of focusing on protecting your capital. Second, seeing big market swings as something to be scared of instead of seeing them as an opportunity to buy great businesses for cheap. And third, and this is the big one we're really going to dig into right now, is the trap of believing you're investing when really you're speculating. And this really breaks it down perfectly. You see, to a real investor, a stock isn't just a ticker symbol. It's a tiny piece of ownership in an actual business. They're digging into the fundamentals, the cash flow, the debt, its competitive advantage. A speculator, on the other hand, just sees the ticker. They're betting on which way the price will move tomorrow, trying to guess what the crowd is going to do. It's a totally different game. So just take a second here. Be really honest with yourself. Which of these 2 columns better describes what you do? There's no judgment here, but knowing where you actually stand, that's the critical first step to building a better, more durable process. Okay, let's tackle another common mix-up. This whole idea that you have to pick a side, that you're either a value investor or a growth investor. The truth is, that's a false choice. It's a myth. You see, for a true investor, that whole distinction just kind of melts away. Like Warren Buffett says, the 2 are joined at the hip. A company's ability to grow its earnings in its business, that's a massive part of its value. So the real question isn't, is this a value stock or a growth stock? The real question is, am I paying a fair price for that company's future growth? The goal is always, always the same. Buy $1's worth of a business for less than $1. Okay, so that's the philosophy, but how do we actually find that value? Let's get practical here. Let's open up the investor's toolkit and look at how to see beyond the surface level numbers that everyone else gets distracted by. So a super common place to start is the price to earnings ratio, or PE. It basically tells you how many dollars you're paying for $1 of a company's profit. So you look at this table, and company A, with that PE of 10, it just looks like the cheapest stock, right? It seems like the obvious bargain. But watch this. See what happens when we factor in just one more variable, growth. Whoa, the entire picture flips on its head. Company C, the one that looked the most expensive at first glance, ended up delivering a massive 175% return. And why? Because its earnings were growing at 20% every year. This is where a tool called the PEG ratio comes in. That's price to earnings divided by growth. Company C had the lowest PEG, which was the signal that it was actually the best value when you considered its future. So earnings are one part of the story. But what if a company isn't even profitable yet? Well, that's when we have to put on our detective hats and dig into the balance sheet to look at its book value. What the company owns minus what it owes. But this is where you have to be really careful because, as we're about to see, not all assets are created equal. So let's look at a fantastic example of tangible, real value. Back in March 2009, a company called Horsehead Holding had $123 million in cash just sitting in the bank. Now get this, its entire market cap, the value of all its stock was only $140 million. So an investor was basically getting the entire business, the factories, the inventory, everything, for just $17 million bucks. That is what investors call a margin of safety. It's that huge cushion between the price you pay and the value you're actually getting. But balance sheets can also hide some pretty nasty risks. And one of the biggest is this kind of ghost asset called goodwill. So when one company buys another one, any amount it pays over the fair value of the physical stuff it gets, factories, equipment, that extra amount gets put on the books as goodwill. It's not cash, it's not a building, it's basically just an accounting plug. And this brings us to a really telling case study. This is the balance sheet for Mueller Water Products back in 2007. Just look at that line for goodwill. $871 million. I mean, it's a huge number, not just on its own, but especially when you compare it to everything else the company owned. And this chart just lays the risk bare. Almost 60% of what Mueller was calling an asset was actually this intangible goodwill. It was way bigger than the value of all their actual property, their plants, their equipment combined. It means the company's book value was basically being propped up by an accounting fiction left over from a big acquisition. So, what do you think happened when the economy hit the skids in 2008? Well, that accounting fiction couldn't hold up anymore. The company had to come clean and admit that the business they bought just wasn't worth what they'd paid. So they took what's called an impairment charge of $400 million. They just erased that much value from their balance sheet, poof, overnight. And for the shareholders, the impact was immediate, and it was devastating. The stock price got cut in half, a 50% drop on the day they announced it. It was just a brutal, brutal lesson in the dangers of trusting a book value that's all puffed up with goodwill. So, we've gone through the market traps. We've looked at the landmines on the balance sheet. But now we have to face the final, and honestly the toughest challenge of all. And this one isn't in the financial statements, it's in the mirror. Because often, the single biggest risk to your portfolio is your own mind. You see, our brains are just wired with these little glitches that are terrible for investing. You've got hindsight bias whispering in your ear, "Oh, I knew it all along," after a lucky pick. You've got self-attribution bias that convinces you your wins are because you're a genius, but your losses are just bad luck. And then there's confirmation bias, which acts like a filter, only letting you see information that proves you were right along. Just recognizing that your brain is actively working against you is the first huge step to taking back control. We've covered a lot of ground here. We've looked at the dangers of speculation, we've opened up the toolkit to find real value, and we've faced those internal biases that can lead us all astray. So the path forward, really, is all about discipline. It's the discipline to build a sound process and actually stick to it. And that leaves us with one final, and I think crucial question for you. Because this isn't just about passively watching an explainer, it's about taking action. So look back at everything we've talked about today and really think about it. What is the one mistake you will commit to not repeating? Because your answer to that question could be the single most valuable investment you ever make. Thanks for joining me.
So, have you ever had that dream? The one where you're starting your own investment partnership, kind of following in the footsteps of legends like Warren Buffett? It's an awesome idea, right? But going from a side hustle to a full-blown profession, well, that takes a serious game plan. So let's dive into this roadmap for building one from the ground up. But before we get into any of the nuts and bolts, we have to start with the right mindset. And honestly, this quote from Mason Hawkins just says it all. Value investing isn't about chasing hot stocks or getting rich quick. It's about discipline, it's about patience, and it's about having the guts to stick to your guns even when the market is screaming that you're wrong. All right, so here's our game plan for this explainer. We're going to hit 5 key areas. We'll start with the core philosophy, the why. Then we'll tackle the 2 make-or-break questions you've got to answer first. From there, we'll get real about the costs, talk about the professional team you absolutely need to build, and wrap up with the most important rule of all.
Okay, let's start at the very beginning, the philosophy. You see, being a really successful value investor, it's less about being a genius and way more about your temperament. Think about it. Most investing mistakes aren't about bad math, they're emotional. This whole philosophy has to be something that you feel in your bones.
And at its core, value investing is just this simple. You're trying to buy something for less than it's actually worth. That gap, that space between the price you pay and the value you get, that's what investors call the margin of safety. It's your buffer. It's your cushion against bad luck, mistakes in your own analysis, or, the crazy curveballs the economy loves to throw at us.
So here's the thing you really need to get. These traits aren't just techniques you can learn from a book. They're part of who you are. You either have that patience, that discipline, or you don't. You either see the genius in buying $1 for 50 cents, or it just won't click. To really succeed at this, it has to be part of your DNA.
All right, so we've got the philosophy down. Now, let's get practical. Let's see how this dream actually starts to look like a reality. Before you even think about spending a single dime, there are two massive questions you have to answer that will literally shape everything that comes after.
And here's the first one. This is the big fork in the road. Is your startup cash going to come from your inner circle, we're talking friends and family, or are you going straight for outside investors? I'm not kidding. Your answer right here determines the entire structure, the complexity, and the cost of your new partnership.
And you can see the two paths right here. A friends and family fund, it can start a lot simpler. The legal docs might only run you about $5,000, and because you already have that trust built in, the demands can be a little easier to manage. But if you're seeking outside money from day one, whoa, you're going to need all the bells and whistles, and that means higher costs and way more complexity right from the get-go. And that brings us to the second huge question. How much money can you actually start with? And look, this isn't just about how many stocks you can buy. This is about your operating budget. The amount of capital you have directly impacts the kind of professional team you can afford, and frankly, how much of the grunt work you're going to have to do yourself.
Now that we've tackled those big picture questions, let's talk numbers. This is the financial reality check. Setting up a real professional investment partnership involves some pretty significant costs, both upfront and ongoing, that a lot of people just don't see coming.
I want you to just let this number sink in for a second. $25,000. A full-blown investment partnership can cost a minimum of $25,000 a year, just in operating expenses. And that is the absolute floor. As your fund gets bigger, or if you're doing anything more complicated than just buying and holding stocks, that number only goes up. This is a real business with real costs.
And hey, that's just the annual cost to keep the lights on. Look at what it takes just to get started. Legal fees to get all the documents drafted, that can easily be $15 to $25,000 right there. Setting up your fund administrator adds another couple $1,000s. And don't forget miscellaneous stuff like mailings and printing. We're already talking about a huge initial investment before you've even made your first trade.
So, where does all that money go? Well, it goes into building your professional infrastructure. And this isn't just a list of expenses, okay? This is you, as the boss, assembling the team that's going to let your fund operate legally, professionally, and effectively.
For a real, fully functioning partnership, you're going to need these 5 key players on your team. You need an attorney, a fund administrator, a custodian or a broker, an accountant, and an auditor. Let's break down what each one actually does for you.
First up, your attorney. Their main job is to draft the legal documents for your fund. This is the legal bedrock, the foundation that your entire partnership is built on. You can't skim here.
And this is the key document they create, the Private Placement Memorandum, or PPM. It's basically the official rulebook for your fund. And here's a pro tip. Using a well-known law firm that does this stuff all the time? Yeah, it might cost more, but it gives you instant credibility with outside investors. It shows them you're serious and you've done things the right way.
Next up is the fund administrator. If the attorney is the architect, think of the administrator as the building superintendent. They handle all the day-to-day mechanics. They process new investors. They do the monthly accounting. They handle redemptions. They basically keep the whole engine running smoothly so you can focus on investing.
Your custodian or your broker is your gateway to the market. Now, you might be tempted to use a cheap online platform, but a full-service broker can be incredibly valuable. They give you access to special situations, international investments, things that are almost impossible to get into otherwise. Trust me, in the long run, their expertise is often worth way more than the extra cost.
And finally, we've got the duo, the accountant and the auditor. Now, they have very different jobs. The accountant is there to prepare the year-end tax forms, the K-1s for all your partners. The auditor, on the other hand, is there for protection. They protect your investors, and they also protect you.
Now, what's really interesting about the auditor is that the requirements can change depending on your size. Any serious investor is going to demand an annual audit. But for a really small fund, maybe just a few $100,000, you might be able to skip a full audit for the first year or two. And for smaller funds, using a good regional firm can be a much more cost-effective way to go.
Okay, we have covered a lot. The philosophy, the big questions, the costs, the team. So let's wrap this all up with the one single, most important principle that should guide every single decision you make from here on out.
It is really this simple.
quality matters most. When you're choosing your service providers, your lawyer, your administrator, your auditor, never ever sacrifice quality just to save a few bucks. It is the definition of being penny wise and pound foolish.
This quote really just says it all, doesn't it? Having your fund handled by pros. It builds trust, it prevents hugely expensive mistakes, and it creates a solid foundation that you can grow on for years. That stability, that credibility, it's going to pay you back way more than any money you thought you're saving up from.
So there it is, the philosophy, the critical first steps, the real costs, and the team you need to build. The road from being a passionate investor to a professional fund manager is definitely challenging, but it's clear. So the real question is, are you ready to start building?